If you're thinking about breaking your mortgage to grab a lower interest rate, to move, to refinance, there's a number the bank is really hoping you don't calculate before you call them. For a lot of Canadians, that can be upwards of $20,000 to $30,000. And the worst part, most people don't find out until the paperwork is already in motion and they have no idea they signed saying that they're okay with this clause. This is what I like to call the mortgage penalty trap. It's the single most misunderstood number in Canadian mortgages, and it's designed, I mean literally structured, to be almost impossible for a normal person to either see coming or avoid. Today, I'm going to show you exactly how it's calculated, the one trick that the big banks use to inflate it, and the moves that you can use to get out of it or avoid it. Now, as always, first off, here's the rules of the video. We're not talking hype, we're not talking rate predictions, we're not necessarily bashing the banks either. We're just bashing this one clause that I find to be a little bit too aggressive. The goal of this is to show you how penalties are actually calculated and how they work, the real math on a real mortgage, and what you can do about it. Here's the rule that's been buried in your mortgage contract. When you break a closed fixed mortgage early, the lender charges you the greater of two numbers. Number one is a 3-month interest penalty, and number two is something called an interest rate differential, or the IRD. And here's the thing, for most people breaking a fixed mortgage, the IRD is the one that's going to hit. It's almost always bigger and uglier and scarier. 3 months interest is the one you hope for. The IRD is the one that you would usually get, especially if you're not like 1 or 2 months away from renewal. Now, you might be asking yourself, what is an IRD? So in plain English, it's the lender's way of recovering interest they would have earned if you had stayed. Take the difference between your contract rate and the comparison rate, multiply it by your balance, and stretch it across the months you have left. Simple enough on paper, but the phrase, a comparison rate, that's where the trap is actually set, because which rate they compare against is an entirely different game, and certain banks have different rates they will use for this. You have to remember, when you signed your mortgage, you probably got a discounted rate. The bank has a posted rate of, let's say, 5.25%, and they knocked it down to 3.25%, and that's what you actually pay on. That 2-point gap felt like a massive win, but here's the trick. When the big banks calculate your IRD, a lot of them, if not all of them, use that posted rate, not the discounted one that you've been paying and that you signed for on your contract. And that same 2% gap that felt like a discount going in, it becomes the exact number they use to inflate the penalty going forward if you try and pay out and leave that bank. And the problem is this can actually double or even triple what you have to pay out in a penalty. Now, these are things that I'm seeing come up a lot more. We saw a lot of it when we saw record interest rates during COVID. We're seeing rates that are lower than they were a couple of years ago. People are asking about penalties, and some of them really suck, again. So we want to share this information, and I'm going to use some real numbers and run some real math for you so you can understand how it works. Let's say we've got a $500,000 balance on your mortgage and a 3.25% rate that you've been paying, and there's 3 years left on your term. 3 months interest, that's about $4,000, which isn't necessarily fun, but it's survivable, it's manageable. Now, the IRD, using the posted rate method, that 2% gap across your balance, across the 3 years you've got left, that break can land right around $20,000 to $30,000. And this isn't an exaggeration. These are penalties I have actively seen in the last 15 years of doing mortgages. Essentially, it's the exact same mortgage, same day. The difference is in the lender. The lender charged the greater of the two, the 3-month interest penalty or the IRD. And if we're using the posted method, it's a significantly larger penalty than what you can get with other lenders like monoline lenders. And the problem with this is a lot of people think they're going to get that 3-month interest penalty. That's what they're banking on. That's what they're expecting. And that's what they're hoping to pay for. So like paying $4,000. But you're not. You're paying closer to 20 or 30 in some cases. That's the trap. That's the one number. That posted rate is what created this. So you might be wondering what this actually means for your wallet. Really, it just means those savings that you were chasing with lower interest rates become an illusion. Because if your cost of breaking your mortgage is $30,000 and you're saving $15,000, you didn't actually win or come out ahead. You ended up paying the bank simply to leave, and you're paying more to move. It just doesn't make sense. And these are the numbers that we calculate when we look at refinances. Are you going to save money on it? Is it going to cost you money? What is your break-even point? These are all important things. And when you have these large-scale penalties, none of it really works. essentially limiting your ability to move your mortgage. And without going into too much detail, it eliminates the idea of doing what's called a no-fee switch or collateral transfer, because with those programs, you can't even roll the entire penalty into your new mortgage. So you have to pay out of pocket for it. Now, I know this all sounds very doom and gloom. It sounds very scary. And you're probably wondering, am I in a lender that's got these penalties? I'm looking to buy in a house. Am I talking to a lender that's going to give me these penalties? And there's a couple of moves you can make to avoid them or to minimize costs and do all these different things. The first thing you're going to want to do is know exactly who you're borrowing from. Not all lenders charge these larger scale penalties because not all lenders use these posted rates in their penalty calculations. A lot of monoline lenders, such as First National or CMLS, calculate the IRD in a far simpler and cheaper way. And sometimes that's the difference between paying a $6,000 penalty and paying a $15,000, $20,000 penalty. It allows you to put more money in your pocket so those transitions to different lenders can actually make sense. Because if you're paying $6,000 to save 12, that makes sense. If you're paying $20,000 to save 12, it doesn't really make sense at all. And in Canada, we have 6 chartered banks? We have over 60 lenders that we work with, most of which are monoline lenders and credit unions. So making sure you shop the market and understand these different lenders is the best way to avoid high penalties down the road. And if you do have to go with a chartered bank, there's some different ways around that too. And I'm going to outline those closer to the end of the video as a little bit of a bonus. Option 2 would be to look at it, and instead of breaking, ask about porting. You can carry your existing rate and term to the new property that you're looking to purchase. This is limited to if you're buying a property, but if you can port and keep the balance the same, in most cases, you don't have a penalty. And if you have to do a port and decrease, so you're decreasing the balance a little bit, you generally get a penalty based on the decrease you have. And if you're increasing, you do a port and blend, well, in that case, you just blend 2 mortgages together. There's still no penalty. So it can save you a lot of money. Now, you do want to make sure you understand the porting clauses in your contract. So ask your broker, your bank advisor, whoever you're working with, to go through those details with you so you have a deep understanding of, can I port? What does it look like? And how does it work? Number 3 is to watch the direction of rates. The IRD only bites when today's rates are lower than the contract rate. If rates have risen above what you're paying, that differential can shrink to nothing, and then you get that 3-month interest penalty that everyone wants. So the timing is kind of everything. If you're in an environment where your rate has increased and you're looking to sell and purchase another house, run the numbers. It might make sense to pay the 3-month interest penalty and get a brand new mortgage instead of porting, depending on how the lender can do that port structure. Now, circling back to what I said in regards to if you have to go with a chartered bank, there are some ways that you can limit your exposure to these penalties. One would be to explore the 5-year variable option, because with a 5-year variable, you're guaranteed that 3-month interest penalty. You just want to confirm that that penalty is going to be based on your contract rate, not the prime rate of Canada. The other way to look at it, if you're afraid of variables, which is rightful, some people are, it's not for everyone, to look at a shorter term fixed rate, like a 3-year fixed, right? If we expect rates to be down lower over the next 3 to 5 years, and it's going to cost you $20,000 to access that if you take a 5-year term, it might make sense to take the 3-year term, ride that out for 3 years, and simply renew into lower interest rates. So if you are working with a chartered bank, that is what I would recommend. Now, with our monoline lenders, there is a program that we are rolling out in our office. It's something very unique to what we're doing. We have a penalty protection plan with select lenders. There's no additional cost for this. There's no additional servicing. It's just something that's included through our office. Essentially, if you take a 5-year fixed with a select lender, like one of these monoline lenders with the reduced penalty, we could be in a position where we can cover half your penalty up to $5,000 if it makes sense for you to refinance to access lower rates. So let's say you've got potentially $10,000, $12,000 in interest savings over the remaining term of your mortgage, right? So let's say there's 2 years left of your term, sorry. If you're going to save like 10 or 12 grand and your penalty is $6,000, we could be in a position to pay $3,000 of that penalty, minimizing the cost of that, allowing you to put more savings in your pocket. Now, this does only work when you work with select lenders that have these low discounted penalties, but I'm a big fan of flexibility and the ability to move. And when I look at penalties, I understand them. They make sense. The bank puts them there because you're breaking your contract. There has to be consequences for breaking a contract. That makes sense to me. But when they become so aggressive that you have virtually no avenue to break your contract and no win scenarios from it, that's where I get a bit frustrated with it. And that's why we created this program to allow people to access lower rates and to be able to pivot and move and grow wealth and equity just that little bit faster. Here's the honest truth about all this. You can't always avoid a penalty. Sometimes breaking genuinely is the right call or unavoidable, but you should never find out that number after you've committed to that mortgage. Not knowing these numbers can truly hurt you or prevent you from achieving your goals and what you want to do. And if you want help running your exact math, what it looks like to break your mortgage term, even if you have an approval from a bank and you want me to take a look at it and tell you what it looks like, I'm here to help. If you want a second opinion on a mortgage you're attaining or a refinance or anything like that, our office is here to help. They're free consultation calls. We get paid when we close mortgages, and we do enough of them that we're completely happy to hop on calls to help people out. And there's a link down in the description below where you can book a call with me and my team where we can help you navigate and fully understand exactly what you've signed for or what you are signing for, because that is crucially important. My name is Myles Nowik, owner of the Nowik Mortgage Team, powered by Andy Mortgage. And if you got value out of this video, if you're still sticking around, maybe hit that like and subscribe button so more people like you can see this video. Thanks so much for your time. Hope you have a great rest of your day. We'll catch you on the next one.